Barry Bannister, Stifel Chief Equity Strategist, and Sherry Paul, Morgan Stanley Private Wealth Management Managing Director. Thank you to both of you. Barry, let's start with you, because this week has been a particular bright spot after weeks and weeks of, negativity. Are you a dip buyer at these levels? Is this a bear market rally that's sustainable?
Sure, it's a summer rally. I was surprised when the S&P 500 fell below that 4,000 mark. I had not expected that. There was a sort of an epiphany in the markets in the month of April that things were tightening up. Those facts had been evident really since the beginning of the year and since the war in February. It's a summer rally. I believe the old high, 4,800 on January 3rd, is very much out of reach. But it's a summer rally, and we'll be watching for credit and PMI indices as the summer progresses. That'll tell us whether we're going to have another dip down towards the late summer, early fall.
Sherry, what's your take? Several analysts have said that the recent price action in stocks actually overestimates the likelihood of at least an imminent recession. Do you think that that's baked into the market at these levels, or do you think there is still significant risk to the downside?
Yeah, thank you so much for having me. The two things we've been telling clients, number one, economic predictions, not to be confused with investment strategies and how to move money through a market like this. They do tell us, though, the climate that we're investing in, and with so much conflicting data, it's turbulent. The second thing we tell them is that how they feel about things, which could feed its way into consumer sentiment, is also not to be confused with an investment strategy. It gives us a sense, though, of the emotional psychology of consumers and investors. And so if there's one thing I think the Americans many things we're great at, but one of them is being smart consumers. That doesn't mean that we don't have the money in the bank to deploy. The same way that corporations and leadership right now there's $10 trillion of cash sitting on corporate and individual balance sheets, that just the sentiment hasn't deployed yet. And so we have to take that into account within this market. And so specifically to your question, if you're an investor sitting in cash, we have a pullback in the NASDAQ and the S&P at these proportions. We haven't seen these PE ratios in a couple of years. We're seeing good dividends. We're seeing, 3.8% unemployment with that cash hanging out. And now we have an inflation sort of number that says that maybe there's a little bit of this that's transitory. Then this is a great time to be, if you haven't started investing, it's a great time to step forward. If you have a portfolio, you should be domestic, dynamic, and adjusting, not abandoning strategies here, and extend out beyond the next couple quarters, because economic data also operates in arrears. Markets are forward-thinking, and investors should be as well.
Speaking of being forward-thinking, Barry, you wrote a couple of days ago that corporate credit could be the potential next shoe to drop, since wider corporate spreads would tighten conditions, which would lead to more PE compression. Can you talk about what kind of risks you're seeing on credit right now?
Sure, Carl. Looks like earnings estimates are going to come down for the year. And one of the things that we're seeing is a margin squeeze in the corporations. So we watch the IG investment grade and high yield spreads, which had picked up quite a bit year to date. As they've come off just a little bit recently, of course, we're getting a rally. But the risk is towards the late summer, early fall, if those spreads widen again, we'd get another sell-off. Because most of the action, as you know, was in treasuries. We had been talking about the TIPS yield for months. The TIPS yield going up is what pressed down on the PE ratio, particularly for growth. That's the Treasury inflation-protected security, or real yield in the Treasury market. But the next thing we have to watch is the corporate side. And that's just going to be something to monitor over the course of the summer, is investment grade and high yield spreads.
And Barry, as for the broader market, you say the S&P upside needs a Fed pause, or the catalyst which would allow such a pause, i.e. lower GDP growth or oil prices. Any sense that we're getting close to that, or is that something perhaps we see by the end of the year?
Mm-hmm. That's a great question. We're going to get 250s on the rate hikes, and then we're going to revert, I think, to quarter points. But I do believe that starting on the November 2nd meeting, the Fed will be waiting for its December 14th meeting SEP, or Summary of Economic Policies, or projections. In a sense, they're going to be talking about a pause. And so you could get, particularly in December, a Santa Claus rally as the Fed pauses at roughly a 2.08 effective Fed funds, which is about where we'll end the year. If they do a 6-month pause, then that's a rally over the course of the winter. If they don't do a pause and they just plow ahead as inflation slows, we'll probably have some trouble in 2023 for the stock market.